Stop everything you're doing right now and listen to me very carefully. It's Tuesday, January 21st, 2026, and what I'm about to show you is something I've only seen twice in my entire career analyzing precious metals markets. Silver is currently trading at approximately $96 per ounce, gold just crossed $4,950, and is within striking distance of $5,000. And if you don't understand what's happening right now, if you don't see the pattern that's forming on the charts, you are about to miss one of the most explosive moves in commodity market history. I'm William Lee, and I need your complete undivided attention for the next several minutes because what I'm going to walk you through is not speculation. It's not hopium. It's not wishful thinking from someone who bought silver at $80 and is praying it goes higher. What I'm going to show you is a technical setup that has appeared exactly 3 times in the last 50 years in silver markets. And every single time this pattern has completed, the subsequent move has been so violent, so fast, and so extreme that people who weren't paying attention literally could not believe the charts were real. 3 days ago, on January 14th, 2026, something appeared on the silver chart that made me stop what I was doing and stare at my screen for a solid 30 seconds. A single candlestick. A green candle so massive, so powerful, with volume so extreme that it erased weeks of back and forth consolidation in a single trading session. This wasn't just a strong day. This wasn't just a breakout candle. This was what traders who've been in commodity markets for decades call a God candle. And if you don't know what that means, if you don't understand why this matters, then buckle up because I'm about to explain exactly why this single candle is potentially the launch signal for a move from $95 to $250 in the next 30 days. Now, before we go any further, I know exactly what some of you are thinking. $250 silver in 30 days? That's impossible. That's insane. That's a 160% move in 1 month. And you're right to be skeptical. Under normal market conditions, that kind of move would be impossible. But here's what you need to understand. We are not in normal market conditions. We haven't been in normal conditions since the Greenland discovery was revealed. We haven't been normal since the tariff trap activated. We haven't been normal since the COMEX registered inventory dropped below 50 million ounces. And we are definitely not normal when gold is about to hit $5,000. What we're in right now is called price discovery mode. And in price discovery mode, normal rules don't apply. Normal support and resistance levels don't matter. Normal technical indicators stop working. Because when a market enters true price discovery, when it breaks into territory where there are no historical reference points, no overhead sellers, no established equilibrium, the price doesn't climb politely. It explodes. Let me show you exactly what happened on January 14th because most people looking at that candle don't understand what they're seeing. They see a big green bar and think nice rally day. But that's not what this was. Let me break down the 3 specific characteristics that define a God candle, and then you'll understand why this is different. Characteristic number 1, the body of the candle must dwarf the recent average by a factor of at least 3, preferably 5 or more. On January 14th, silver opened near $78.42 and closed near $92.25. That's a move of $13.83 in a single session. The prior 20-day average trading range for silver was approximately $264. Do the math with me. 1383 divided by 264 equals 5.2. This candle was more than 5 times the size of the average recent candle. That's not just big, that's structural. Characteristic number 2, volume must explode to at least 300% of the recent baseline. And I'm not talking about 10% or 20% above average. I'm talking about volume that is so extreme that it indicates institutional players, hedge funds, sovereign wealth funds, and major commercial entities are moving massive size. On January 14th, reported futures volume was approximately 947,000 contracts versus a recent 20-day average of around 223,000 contracts. That's 425% of normal volume. That's more than 4 times the typical daily activity. You don't get that kind of volume from retail traders on Reddit getting excited. You don't get that from stackers buying coins. That volume comes from entities that move hundreds of millions or billions of dollars at a time. That volume comes from players who are either terrified of being caught short or extremely confident about upside, or both simultaneously. That volume tells you that the market's internal structure is changing in real time. Characteristic number 3, the close must be near the top of the day's range with minimal upper wick, showing that buyers maintained control throughout the entire session and into the close. On January 14th, silver ran up to a high around 92.94 and closed at 92.25. That's a close within the top 2% of the session's range. There was almost no rejection. There was almost no selling pressure at the highs, just relentless, persistent buying that stayed in control from the open all the way to the close. When you combine those 3 characteristics, massive body, massive volume, and a close near the highs with minimal rejection, you get something that is statistically rare. This type of candle appears maybe once every few years in commodity markets. And when it appears, it's not random, it's not noise. It's information, it's the market screaming at you that the previous structure, the previous equilibrium, the previous balance between supply and demand has broken. Something fundamental has changed. Now here's where this gets really interesting, and this is the part that most analysts are completely missing. Silver has had strong days before. We've seen big green bars over the last decade. But most of those big green bars happened in markets where there was overhead resistance waiting, where there were sellers lined up at certain price levels, where the paper market could manufacture supply by issuing more contracts and creating more synthetic silver to meet demand. This God candle on January 14th printed in a completely different environment. It printed in a world where three critical conditions have aligned that make this setup unlike anything we've seen since 2011 and possibly since 1980. Condition number one, overhead resistance is essentially gone. Silver has pushed into all-time high territory. That means the usual reference points that traders rely on have disappeared. There isn't a clean multi-year resistance level where you can say sellers will definitely show up here. When price enters all-time high territory, it enters what we call discovery mode. And discovery mode is not calm. It's not orderly. It doesn't politely consolidate and give everyone a second chance to buy lower. Discovery mode is where gaps happen. It's where air pockets appear. It's where the market runs so far ahead of expectations that people watching from the sidelines experience what I call chart disbelief. They look at the price and think, that can't be real, but it is real. And by the time they accept that it's real, the price has moved another 20% higher. Condition number two, the seller side has thinned out dramatically. And this is critical. When the majority of the open interest in the silver market is held by entities that aren't trading for fun, when it's held by industrial users who need physical metal, by long-term strategic accumulators, by sovereign wealth funds, by entities that are buying silver not as a trade but as a strategic position, those entities don't behave like day traders. They don't dump their positions because an oscillator looks overbought. They don't panic sell on a 3% pullback. They don't care about short-term technicals. They care about securing supply. They care about hedging currency risk. They care about strategic positioning. And when the market is dominated by those types of participants, selling pressure at any given price level becomes extremely thin. That's why God candles often have tiny upper wicks. Nobody is really offering size into the move because the holders aren't interested in selling. Condition number three, the paper market's ability to print its way out of problems is getting constrained by delivery stress. And this is the part that makes traditional commodity analysts extremely uncomfortable because it challenges the fundamental assumption that futures markets always have enough liquidity. Here's the reality. If the COMEX has a massive amount of paper promises outstanding, but a rapidly shrinking pool of registered physical metal that can actually be delivered against those contracts, the entire system becomes a timing problem. Because the moment too many contract holders simultaneously demand physical delivery, the exchange faces a choice between several ugly options. They can implement cash settlement, which destroys confidence in the market. They can impose emergency rule changes like position limits or forced liquidation. They can raise margin requirements to force speculators out. They can implement trading halts. All of these options send the same message to the market. Physical metal is tight and the paper price is no longer reflecting physical reality. And when physical is tight, when the ratio of paper claims to actual deliverable metal gets too high, the path of least resistance for price is straight up. Because every entity that needs real metal, not a cash-settled contract, but actual physical silver, is going to bid aggressively to secure supply before it disappears entirely. Now, I'm not telling you this to make you panic. I'm not telling you this to create fear. I'm telling you this because the God candle we saw on January 14th is exactly the kind of signal that appears right before the broader market realizes that the game has changed. And to prove that this isn't just theory, to prove that this pattern actually predicts major moves, we need to look at history. Let me take you back to 1979 and 1980. This is the last time silver entered true price discovery mode with a structural supply deficit. Silver didn't climb like a staircase in that period. It moved in three distinct phases, and understanding these phases is critical to understanding what might be coming next. Phase 1 was the slow grind. From the low single digits up into the teens, the move was messy. It was volatile. It was boring for long stretches. Most people ignored it completely because it looked like random noise. Phase 2 was acceleration. Silver ran from the teens into the 20s and 30s, and suddenly everyone started paying attention. The financial media started covering it. Mainstream investors started asking their brokers about it. The move had legitimacy. Phase 3 was the vertical move. This is the phase that looks illegal when you see it on a chart. This is the phase where price doubles in weeks, where it moves so fast that people think the data feed is broken. In that era, the final parabolic burst was measured in days and weeks, not months. The part of the move that made people wealthy happened so fast that if you weren't already positioned, you had no chance to get in at reasonable prices. Now jump ahead to 2010 and 2011. Same pattern, different numbers. There was a grind phase where silver moved from $12 to $20 over 18 months. There was an acceleration phase where it ran from $20 to $35 in a few months. And then there was a vertical phase where it went from $35 to $49 in a matter of weeks. And what marked the transition from acceleration to vertical in both of these historical examples? A monster candle on monster volume with almost no rejection, a signal that the market had entered no reference points territory. So when I look at the candle from January 14th, 2026, I don't just see a strong day. I see a phase change. I see the market transitioning from phase 2 acceleration into phase 3 vertical. And if I'm right, if this pattern holds, the move we're about to witness in the next 30 days is going to be so extreme that people who aren't paying attention right now will not believe it's real. Now, I can already hear the skeptical voices. William, a single big candle doesn't guarantee anything. The market can reverse tomorrow. This could be a bull trap. And you're absolutely right. A single candle in isolation is not a prophecy. It's not a guarantee. But a God candle combined with certain confirming signals creates a high probability setup. So let me stack the evidence for you piece by piece so you can see the full picture. Let's start with the weekly RSI. Yes, it's screaming overbought. It's deep into the 80s, potentially touching 90, and that scares people who learn technical analysis from textbooks. Because textbooks teach you that when RSI gets above 70, you should be cautious. When it gets above 80, you should be looking to sell. But here's what those textbooks don't emphasize enough, and what most retail traders don't understand. In commodity markets during discovery phases, overbought conditions can persist for weeks or even months. Overbought is not always a sell signal. Sometimes it's simply the signature of a market in runaway mode. Sometimes it's the fingerprint of a short squeeze combined with genuine physical demand overwhelming available supply. If you sold every time RSI hit 80 during the 2010-2011 silver rally, you would have been stopped out in early 2011 and missed the entire move from $35 to $49. If you sold every time RSI hit 80 during the 1979-1980 rally, you would have missed the vertical phase entirely. Overbought in discovery mode is not a warning, it's confirmation that the market has entered a different regime. Now let's talk about the physical market signals, because this is where the God candle story gets validated by real-world stress indicators. First, lease rates. When the cost to borrow physical silver spikes dramatically, it's not a meme. It's not market manipulation. It's a genuine stress indicator. It's the market telling you that physical metal is scarce and entities that need to borrow it to meet obligations are willing to pay premium rates. In mid-January 2026, lease rates surged to levels we haven't seen since the 2021 squeeze. That kind of move doesn't happen randomly. It happens when someone, somewhere, needs physical metal urgently. Maybe they need it to cover a short position. Maybe they need it to fulfill a delivery obligation. Maybe they need it to settle a contract that's about to default. But whatever the reason, elevated lease rates tell you that the physical market is under stress. Second, physical premiums. If you've tried to buy silver coins or bars in the last week, you already know that spot price is not the real all-in cost. Premiums on American Silver Eagles are running $18 to $22 over spot. Premiums on Canadian Maples are $15 to $18 over spot. Even generic rounds are commanding $8 to $12 premiums. When premiums stay elevated and wide, it means one of two things is going to happen. Either physical supply suddenly floods the market and premiums collapse, or the paper spot price rises to close the gap with physical reality. History shows that in tight markets, it's almost always the latter. The paper price eventually catches up to where physical has been trading all along. Third, inventory stress. This is the big one. When deliverable inventories at the COMEX shrink while the number of outstanding paper contracts remains huge or even grows, the mathematics become uncomfortable. If there are 200 million ounces of paper claims but only 50 million ounces of registered physical metal available for delivery, the system depends entirely on most participants not asking for delivery at the same time. That's fine until it isn't, and God candles tend to appear right when the until it isn't moment starts creeping closer. We are currently at one of the lowest registered inventory levels in COMEX history, while open interest remains near all-time highs. That's not a sustainable situation. Something has to give. And when something gives in a commodity market with tight physical supply, price goes vertical. Now, let me lay out a practical timeline for you, because saying $250 silver in 30 days sounds like science fiction unless you understand how discovery moves actually unfold in real time. Think of this as a 3-act play, and we're currently somewhere between Act 1 and Act 2. Act 1 is digestion. After a candle like January 14th, the market often pauses. Not because the bullish thesis died, not because the move is over, but because the market needs time to absorb the shock. Buyers who chase the God candle take some profit. Shorts regroup and attempt to cap price. The chart chops between levels. Volatility remains extremely high, but price holds above key support zones. If silver spends several days consolidating in the $90 to $98 range without breaking down, that's not weakness. That's strength. That's the market accepting higher pricing. That's the new floor being established. And acceptance is fuel for the next leg, higher. Right now, as I'm recording this on January 21st, we're in this digestion phase. Silver is holding the mid-90s. It's not collapsing. It's not giving back the God candle. It's building energy for the next move. Act 2 is the breakout. Once the market senses that dips aren't working, that sellers are scarce, and that every attempt to push price lower gets bought aggressively, it makes the next push. A clean close above $100, which is a massive psychological level, becomes the ignition point. News headlines begin, CNBC runs segments on silver, Bloomberg publishes analysis pieces, Reuters interviews mining executives, financial commentators who completely ignored silver for the last 3 years suddenly have opinions about it. Momentum following funds receive buy signals from their algorithms. Systematic traders get triggered, stops get hit on the short side, and every short that covers is a buy order that pushes price higher. This is where FOMO starts to enter the market in a meaningful way. Act 3 is the squeeze in the air pocket. This is where people absolutely lose their minds because price stops moving in rational increments. The chart doesn't offer nice entries. It doesn't pull back to convenient support levels. It gaps overnight. It runs 8% in a session, pauses for a day, then gaps another 10% the next morning. If the market enters a zone with extremely low prior volume acceptance, what we call an air pocket on the volume profile, it can travel ridiculously far before it finds genuine resistance, because there's simply not much supply in that price range. Nobody owns silver with a cost basis at $180. Nobody has sell orders sitting at $200. So when price enters that territory, it's shooting through vacuum. And this is where the 30-day timeline comes from. In past silver vertical moves, the steepest part of the rally, the part that generated 80% of the total gains, happened in the final 20-30 days. Not 6 months, not a year, 3 to 4 weeks. That's how fast discovery mode can move when physical scarcity meets paper market stress. Now imagine that historical pattern, but overlay it with today's conditions. Deeper structural deficit than 2011, broader industrial demand from solar, EVs, and 5G, geopolitical competition for Arctic resources, central banks printing currency at unprecedented rates, gold approaching $5,000, which means the entire precious metals complex is in a bull market. The setup is even more explosive than historical precedents. Here's the part that's going to mess with your head, and I need you to be prepared for it psychologically. The market will try to bait you with normal thinking right when conditions stop being normal. You'll see a $5 pullback, and 20 analysts will declare the move is over. You'll see one red day, and the financial media will publish articles titled, "Silver Rally Loses Steam," or "Is the Silver Bubble Popping?" Then 48 hours later, silver will rip $15 higher overnight, and those same voices will pretend they saw it coming. This is the psychological warfare that happens in parabolic markets. The crowd is always looking in the rearview mirror, trying to apply historical norms to a market that has left history behind. So I want you to watch one specific thing over the next few trading sessions, and this will tell you more than any indicator or oscillator. Watch how price behaves on pullbacks. Does it dip on low volume and rebound quickly? Or does it dump on heavy volume and struggle to recover? That single difference tells you whether the big money, the smart money, the institutional players are quietly accumulating on weakness, or whether the move is actually failing. If every dip is bought immediately on low volume, if price snaps back within hours, that's accumulation, that's strength, that's confirmation that the bid is real and deep. And here's another thing to watch closely. Any announcements from the COMEX about margin requirement increases, position limits, or emergency rule changes. Those announcements don't happen when everything is fine. They happen when the exchange is under stress. They happen when the clearinghouse is concerned about member solvency. They happen when the system needs breathing room. If you see multiple margin hikes in a short period, that's not bearish. That's actually extremely bullish because it confirms that the short side is in trouble and the exchange is trying to reduce systemic risk by forcing speculators out. But forced covering creates buying pressure, which pushes price higher, which forces more covering. It's a reflexive loop. Now let me speak directly to two different groups watching this video right now, because your situation and strategy should be completely different based on what type of participant you are. If you're trying to actively trade this move, if you're using leverage, if you're playing with futures or options, I need you to understand the environment you're in. God candle markets are absolutely brutal to trade. They rip up violently and then drop 7% in 2 hours. They stop you out on a pullback and then run without you. They punish over leverage. They reward patience, position sizing, and emotional control. If you insist on trading this, go smaller than your ego wants. Use wider stops than you think you need. Respect the volatility. Don't pretend you can perfectly time every $10 swing. Because you can't. Nobody can. The traders who make money in environments like this are the ones who accept that they'll miss some moves, that they'll take some losses, but who survive long enough to catch the big trends when they unfold. If you're holding physical silver or building a long-term strategic position, your advantage is completely different. You can tolerate chaos because you're not on margin. You're not forced to sell. You don't get margin calls. You can ride out 10% pullbacks and still participate in the larger 200% move if the thesis plays out. Your enemy is not volatility. Your enemy is losing conviction and selling at exactly the wrong time because you got scared. Now, let me tackle the elephant in the room, the big claim. Why could this move genuinely extend to $250 or beyond when $100 seems like such a huge psychological barrier? Because the $100 level is psychological, not structural. It's a round number that humans like because we have 10 fingers. But industrial demand doesn't care about round numbers. A solar panel manufacturer doesn't stop production because silver hit $100 and traders feel nervous. They stop when the cost of silver becomes so prohibitive that they're forced into redesigns, forced into substitution, forced into canceling orders. That's called demand destruction. And demand destruction in commodity markets historically happens at price levels that shock everyone, because it requires price to become painful enough that actual behavior changes across entire industries. That doesn't happen at $100. It might not even happen at $200. So the real question isn't, can silver hit $100? The question is, at what price does the world actually use less silver? And given that silver is essential for solar energy, for electric vehicles, for 5G infrastructure, for medical devices, for water purification, for electronics manufacturing, that price is probably much, much higher than most people think. Now, I want to be completely transparent with you. I cannot pinpoint the exact top of this move. Nobody can. In discovery mode, the market writes the script in real time. But I can tell you exactly what I'm watching as this unfolds, and these are the indicators that will tell us whether the vertical phase is continuing or whether it's exhausting. I'm watching whether pullbacks get bought aggressively within hours or whether they develop into multi-day corrections. I'm watching whether physical premiums stay elevated or whether they start to compress back towards spot. I'm watching whether lease rates remain stressed or whether they normalize. I'm watching whether the gold to silver ratio continues to compress, because GSR compression during a precious metals bull market often signals that silver is in outperformance mode. And most importantly, I'm watching price behavior at round number levels. If silver gets to $100 and consolidates for days or weeks, that's healthy. That's normal. But if silver blows through $100 with barely any pause, if it treats $100 like it's nothing and keeps running to $115, $120, then we're in a true mania phase and the upside targets get thrown out the window. Here's the psychological trap that catches most people, and I want you to be aware of it so you don't fall into it. The most dangerous part of a silver rally is not the first breakout. It's what happens after the crowd finally believes. That's when the move becomes reflexive. That's when it becomes self-reinforcing. Prices rise, which draws attention. Attention draws more money. More money pushes prices higher. Higher prices force short covering. Short covering creates more headlines. Headlines pull in more retail buyers. More buyers push prices even higher. It's a feedback loop. And that feedback loop can push price far beyond what fundamentals alone would justify in the short term. That's exactly why the final leg of historical silver moves has always looked insane. Because once the reflexive phase kicks in, once the momentum feeds on itself, the move becomes disconnected from rational valuation. It becomes about positioning, about fear of missing out, about shorts desperately trying to cover before they're liquidated. So here's what I want you to do right now. First, don't sleepwalk through this moment. Whether you're bullish, bearish, or neutral, pay attention. We are potentially living through one of the great commodity moves of our generation. Second, if you're not already positioned and you want exposure, think very carefully about how much risk you can actually handle. Because if this move unfolds the way I think it might, the volatility is going to be absolutely insane. Third, if you're already holding silver, either physical or paper, have a plan. Know under what conditions you would take partial profits. Know what signals would tell you the move is over. Don't just wing it based on emotion when you're up 150% and scared of giving it back. And fourth, document this moment. Take screenshots of the charts, save the news articles, record your thoughts and feelings, because if this unfolds into a true vertical move, you're going to want to remember what it felt like to live through it. You're going to want to show your grandchildren the charts and explain that you were there, that you understood what was happening, that you had the courage to act when everyone else was paralyzed by disbelief. Let me give you one final thought that I think puts all of this into perspective. Markets don't move when everyone is comfortable. They don't make history during periods of calm consensus. Markets make history when structure breaks, when the old rules stop working, when the crowd is looking the wrong direction, when something fundamental shifts and price has to find a new equilibrium. The God candle on January 14th, 2026 looks like a structural break. The fact that gold is approaching $5,000 confirms that the entire precious metals complex is repricing. The fact that silver is holding the mid-90s after that explosive move tells us the bid is real. And the fact that physical premiums remain elevated, lease rates remain stressed, and inventory remains tight tells us the supply situation is genuine. So whether silver goes to 150, 200, 250, or some number that sounds absolutely ridiculous today, the underlying message is the same. We are in a different phase now. The slow grind is over. The acceleration phase is ending. We are entering or have already entered the vertical phase. And vertical phases don't last long. They burn bright and fast. And if you're not positioned, if you're not paying attention, you will miss it. The next 30 days could rewrite the silver market. The next candle might be even bigger than the God candle. And by the time the financial media figures out what's happening, by the time your neighbor asks you about silver, by the time CNBC runs a special on the silver surge, it will already be too late to get in at reasonable prices. This is William Lee. This is the moment I've been preparing you for. This is why we analyzed the Greenland discovery. This is why we tracked the tariff trap. This is why we monitored the COMEX inventories. Everything has been building toward this. The God candle was the signal. Now we watch to see if the prophecy fulfills itself. Stay sharp, stay disciplined, keep your eyes on the charts, and whatever you do, don't let fear or greed make your decisions for you. Trade with your head, not your heart. And remember that the goal isn't to catch every dollar of the move. The goal is to position yourself intelligently, manage your risk properly, and be part of something historic. This is happening, right now, in real time. And I'll be here documenting every step of the journey. Welcome to the vertical phase.